A $750 billion promise. That's the price tag the European Union just slapped on American energy. Oil, natural gas, even nuclear fuel as part of a headline-grabbing trade deal with the United States. And while the ink is barely dry on this, the opportunity for investors is already heating up. Europe's energy divorce from Russia has triggered a global reshuffling, and guess who's stepping into the void? The United States, now the EU's top supplier for LNG and oil. But to meet this deal, $250 billion per year target over the next 3 years, oil producers, equipment services, and exporters are going to need more capacity, more infrastructure, and a lot more investment. In this video, I'm going to be breaking down what this mega deal really means, why the numbers matter, even if they're aspirational, and which U.S. stocks are set to ride the next energy export supercycle straight to the bank. Into that deal, though, the U.S.-EU energy deal aims to transform the U.S. into Europe's go-to energy partner, replacing its long-standing dependence on Russian oil and gas. Announced with a jaw-dropping commitment of $750 billion over 3 years, the EU has pledged to purchase $250 billion annually in American energy, primarily crude oil, liquefied natural gas or LNG, and nuclear fuels. In 2024, total U.S. energy exports reached $318 billion globally, with $76 billion of that heading to the EU. That already made the U.S. the EU's top supplier, covering 44% of Europe's LNG and 15% of its oil imports. But to hit that deal's target, exports would need to more than triple, sparking a wave of opportunity for American energy producers, shippers, and infrastructure developers. Now, from a supply side, the U.S. is ready to meet that challenge, at least on paper. Crude oil production hit a record 13.5 million barrels per day in May, driven by gains in Gulf and Texas fields. But it's the infrastructure here that remains a bottleneck. LNG terminals are near capacity, and pipelines, storage, and shipping networks are all going to need aggressive expansion to fulfill this demand. And that's where the investing angle gets even more interesting here. The reversal of the Biden-era LNG pause, part of a pivot back to energy dominance strategy for this administration, clears the runway for new export projects. Billions have already been funneled into LNG terminal expansions along the Gulf Coast, and U.S. companies are jockeying for long-term supply deals with European buyers eager to reduce their Russian exposure before the EU's 2028 cutoff. Nation, this is exactly where I love to invest, alongside those unstoppable big-picture trends that are going to be driving stocks for years. The EU's transition from Russian energy to American supply is already underway, and Washington has every incentive to cement this leadership. This sets the stage for a U.S. energy export renaissance that could lift not just LNG giants like Cheniere, but also pipeline operators, midstream pipeline players, oil producers, and nuclear fuel suppliers. Bottom line here, whether or not the EU hits that full $750 billion mark, the direction of trade is clear and the investment opportunity is enormous. First up, one of the biggest beneficiaries, Cheniere Energy, ticker LNG, already up 25% over the past year. The export industry for liquefied natural gas, or LNG, stands to be one of the biggest winners from this energy deal. Europe has already turned to the U.S. for nearly half of its LNG imports, but to meet the deal's target, that volume would need to more than double. That means higher utilization at existing export terminals and accelerated development of new ones, especially along the Gulf Coast. Companies like Cheniere Energy and Tellurian have been well positioned to benefit as Europe shifts away from Russian gas and seeks that long-term supply stability. Then the recent reversal of the Biden-era LNG pause also clears the path for new federal approvals, while rising European demand strengthens the pricing power and contract terms for those U.S. exporters. Cheniere is positioned as the pure-play LNG lever on this theme. While the headline figure is debated, the direction of travel is unmistakable. Europe wants more non-Russian gas, and U.S. LNG is the scalable alternative. Cheniere already has a disproportionate footprint in Europe. It delivered 25% of Europe's LNG imports in 2024 and about 11% of global LNG. And that's important because this share of wallet with European utilities and portfolio players increases that familiarity, reliability, and the FOB flexibility exactly when Cheniere excels. On the commercial side, Cheniere's model is built to be a durable advantage. Roughly 90% of 2024 volumes were tied to long-term sale and purchase agreements, with a relatively small merchant marketing slice, meaning cash flows are largely insulated from those swings in commodity prices, while still giving management enough uncontracted headroom to make money when those prices do jump. And this is visible in profitability. Even as benchmark LNG prices eased from 2023, the operating margin reached 39% in 2024 and accelerated to 55% in the second quarter, helped by portfolio optimization and pricing pass-through mechanisms. And capacity is the other big upside here. Cheniere ended 2024 at about 45 million tons per year, or MTPA capacity. By mid-2025, management believes it gets to 49 MTPA operating and a little over 12 million tons under construction, including its Corpus Christi Stage 3 and a new mid-scale trains 8 and 9. That pipeline is going to underwrite multi-year growth and offtake and support those sale purchase agreements, like the 1 million ton JERA deal that runs through 2029 through 2050. Decades worth of revenue that's already contracted and sold. Now, of course, this is not all without risk, with analysts arguing that $750 billion deal is ambitious to say the least, especially given market-driven EU procurement, existing non-US contracts, and the infrastructure constraints. Now, if realized volumes do disappoint, the benefit to U.S. exporters is going to be more incremental. Still, contract backlog, ongoing build-out, and Europe's structural need should push for significant cash flow for decades here. Revenue is expected up at a very strong 32% this year to $20 billion, and while sales growth is lumpy, basically ebbing and flowing when new capacity is sold and built, this EU deal supports that growth into the high double digits. And surprisingly, after that 25% run in the share price, the stock isn't expensive on a historical basis. Shares trade for 2.8 times price to sales, well under the high of almost 3.4 times over the past year, and the current market cap of $50 billion is only about 2.4 times this year's expected sales, a 29% discount to that valuation peak earlier this year. And we're just getting started, but nation, even the best stocks aren't going to mean a damn thing if you sell too early or hold on to those losers too long. Investors are always asking me to review their portfolios, and now I'm doing just that. For the first time ever, I'm offering one-on-one portfolio reviews to all you out there in the Bowtie Nation. This is going to be part of a large-scale research project I'm doing to understand investor behaviors and better help you invest. If you're interested, use the link I'll leave in the description to learn more. On that page, you're going to share your investments that you've bought and sold over the last 3 years, along with your goals and your risk levels. With that, we're going to be able to see if your actual investments match your goals, if you're selling too early or too late. I'm going to then personally review your investing strategy, highlighting risks and opportunities, and give you actionable suggestions to align with your goals. Now, I'm not selling anything here, folks, and I won't try to when we talk. I'm going to be using the data to research investor behavior, so you'll also be helping other investors, but I will never share your name or your data with anyone. This is going to be a big project, so spots are limited. If you want in, look for that link below and get your free one-on-one. Back to our list, though, and another leader in the segment I've been watching, Baker Hughes, ticker BKR, up 24% over the last year with a big bump on that deal announcement. Equipment and service companies like Baker Hughes and Chart Industries are poised for massive tailwinds from that US-EU energy deal. As exports surge to meet European demand, everything from existing terminals that need it upgraded to new facilities and exploration is going to be set into overdrive. And this build-out isn't just limited to major players. It's a full-scale industrial boom involving engineering, fabrication, and long-term maintenance contracts. Many of these projects span multiple years, offering consistent revenue visibility for these service providers. For Baker Hughes, the EU deal is a big driver across multiple segments. First, the industrial and energy technology, the IET franchise, gas turbines, compressors, LNG trains, rotating equipment services, that already sits on a record $31.3 billion backlog and posted $3.5 billion of Q2 orders, despite no mega LNG awards that quarter. The company even raised its IET guidance on momentum, including a $550 million of data center power orders. So a European buying wave, even if that $750 billion turns into a pipe dream, would translate into additional compression, turbo machinery, and long-cycle services orders for liquefaction, midstream gas, and regas terminals, all squarely in IET's wheelhouse. Second, the newly announced $13.6 billion acquisition of Chartered Industries would take Baker Hughes deeper into cryogenics and heat transfer, critical kits for LNG and for emerging high-powered loads like AI data centers. Strategically, that expands BKR's share of future LNG and gas power projects that might be accelerated under this EU deal, while also opening up other segments to growth like industrial gases and hydrogen. Now, if we do start to see equipment and services take off from that EU deal, this is where it's going to become a big upside surprise. Baker Hughes is forecast to see revenue fall almost 2.5% this year and post sub 2% growth next year, so any growth is going to be very welcome by investors. And while the stock trades around its historical price multiple at about 1.5 times price to sales, if we see any of that growth come, either from the IET franchise or the Chart LNG acquisition, investors are going to be bidding this one up. I'm going to reveal another stock to buy in this theme, one with a massive vote of confidence by Warren Buffett himself. But as much as I love this kind of big picture trend following strategy of investing, I found another way to invest that's like having a crystal ball on the market. Check out the video here in the corner next to see how I'm using the prediction markets to see where investors are going next and how to spot the stocks you need to be watching. Occidental Petroleum, ticker OXY, isn't exporting LNG or oil, but is a strong producer with a vote of confidence from the Oracle himself. Now let's start with what OXY can control in all of this, operations and costs. Management is guiding to as high as 1.4 million barrels of oil equivalent per day in 2025, with domestic lease operating expenses around $8.65 per barrel of oil. A solid cost base that preserves margin even if prices weaken. It takes the stock higher if energy prices jump. Just as important, Oxy has repaid $7.5 billion in debt in 13 months and lined up $950 million of additional divestitures, lowering its interest burden and raising resilience into next year. Oxy's strengths are solid and getting better. Buying Crown Rock made Oxy bigger in the Permian Basin, a top U.S. oil field, and added a lot of good drilling spots. That's helped push Oxy's proven oil and gas reserves to a record level of $4.6 billion barrel proved reserves, and they're finding more barrels than they pump each year, so they can keep that production steady over time. Occidental also has a special know-how for squeezing more oil out of those old wells by pumping in carbon dioxide. On top of that, the company is building out a carbon business. Its huge Stratos plant is starting to pull CO2 out of the air, and it already has government approval to store that CO2 deep underground. Folks, even if Europe ends up spending a part of that $750 billion on cleaner energy and carbon projects as it moves away from Russian supply, Oxy's carbon skills and assets could become a bigger deal and could help lift this stock. And that's going to make Warren Buffett even richer, with his Berkshire Hathaway the largest investor in Occidental. Berkshire holds over 264 million shares of the company, the seventh largest holding in the portfolio, giving him 27% ownership of Occidental, along with warrants to buy another 84 million shares. Now, Buffett has said he doesn't intend on taking over the company, but with almost a third of the shares, that could change real fast. Occidental is another one that analysts don't expect much from this year, with sales seen falling 1/3% this year and then growing by less than 3% next. Here we do see a relative discount though, with the stock trading for 1.6 times price to sales, well off the 2.2 times sales multiple it traded at that peak when Buffett started buying the shares. So this is a part of the market where investors haven't yet priced in that upside to the EU deal or America's growing energy dominance, and that could mean surprise upside returns if you're ready. Get your free one-on-one portfolio analysis with me through the link in the description, but only over the next month, so do not wait on this. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.